Financial advisory organization, the deVere Group, has launched a new investment strategy division. And joining us from London is Tom Elliot, the deVere investment strategy head. Good to have you on the program again, Tom. It wasn't long ago we were talking to you and, in fact, to your colleague Nigel Green about what the super rich are thinking about. What is it that is occupying their minds at the moment?
I think increasingly, especially since the market tremors we saw in October, there's an appreciation that investment isn't just about going for returns, but it's also about managing risk. So what we've found increasingly is that our conversations with clients are about diversification, sometimes into asset classes that rich investors might already be in, perhaps be in to a far greater extent than they appreciate, such as property, and sometimes in asset classes that they've never really ventured into, and we would encourage perhaps government bonds and the like.
Are they getting concerned, though, the super rich? Because when economic environments are turbulent, as they are at the moment, if you've got it, there's kind of a desire to hold on to it rather than perhaps risk.
I think that caution is a very necessary, if you like, defense mechanism within the human psyche. But if you're looking to increase your net wealth, you do have to take risk. And it's about balancing the two. And I would add that for the very rich individuals, if you like, there's more freedom to take speculative bets with excess cash than for less rich people. And hence, that's why the super rich are the ones who invest in wine, stamps, and other less liquid, more speculative areas. So I take your point entirely about the need for caution. But for the super rich, in a way, there's a curve that the curve of risk goes up. The amount of risk they're willing to take, the more excess cash they have.
You've launched a new investment strategy division that's at deVere, and I was looking through your marketing material. You've got 80,000 clients. It's quite a nice asset base to go into. It also sounds a little like you're moving into the media business.
Well, what we're trying to do as an advisor is to offer our clients the same amount of qualitative and quantitative information about the markets that a financial advisor would get, and hopefully in an accessible format. So without wanting to sound preachy, we're sort of democratizing the information flow to the extent that actually we offer a model benchmark for a multi-asset fund that can actually be replicated by using Luxembourg-based or Irish-based ETFs. So we don't just show a benchmark that's 45% equities, 40% bonds, 10% commodities, 10%, 5%. Sorry, it's on the website. But if you click on that, you can then get the breakdown, detail by detail, of the weighting in US equities, European equities, emerging markets, and so on. And as I said, those are replicatable with ETFs. So you can actually build a good, I believe, a good model multi-asset portfolio without using our services, just using your ETF provider. But I think that'd be a shame, because one of the reasons why deVere has become one of the largest advisors in the world to the expat market is because of our client service. We definitely add a qualitative added value through using our services. But as I said, the site itself should provide the intelligent investor with a lot of information that will enable them to make informed investment decisions.
Bit of a freemium model to a degree. I'm sure Chris Anderson would like what he hears there. But Tom, a South African,
it's
freemium. So some people come in and get it for free. Other people are going to use your services. But just give us an insight into how your South African clients are reacting. We, sitting in this country, get lots of feedback that South Africans who've got money are trying to get it offshore as quickly as possible. Are you seeing that?
I mean, this is quite an old issue with clients in South Africa, and I can't really comment on any nearby trends. I'm not. I just don't have that information. But I think you've got to look at the South African scenario, if you like, an investment scenario in two ways. If we are able to see a move towards liberalizing the economy, and that does mean taking on unions, it means, as the World Bank report on South Africa last spring said, opening up product markets, too many product markets, by which I mean consumer goods that you buy in the shops. When you go up the supply chain, you see there isn't enough competition. And you know, in retail, is there really that much competition, for instance, in retail distribution outlets? So we need to see a whole bunch of economic changes. And then South Africa will definitely be an interesting investment spot, not only for foreigners to go into, but for local South Africans to be reinvesting their money. The second scenario is unfortunately a more negative one, and then no doubt we would expect to see capital outflow. But I don't think one should automatically. South Africa has surprised. Who would have thought 20 years ago that South Africa would be enjoying the economic prosperity that it has now, that your central bank would have remained independent and be such a strong pillar of the economy, for instance. So I think it'd be totally wrong to take an automatically negative view and say, oh, if you've got half a brain, you'd be taking money out of South Africa. I think there are definitely possibilities as we go forward for change, particularly as we see the ANC loosen its political grip somewhat.